أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله والصلاة والسلام على رسول الله وعلى آله وبارك. Assalamu alaikum, dear students, and I welcome you all to another session of video lectures of financial statements analysis. Inshallah, in our today's lecture number 5, we'll have discussion on the cash flow statement, and we'll have a practice and prepare the cash flow statement, inshallah. But before that, we'll have discussion on the previous lecture, and after that we'll have discussion on two general but related terminologies, which is global and multinational companies, and also globalization versus harmonization. So let's begin with the first content, the first objective of this lecture, which is the review of the previous lecture. In previous lecture number 4, we had discussion on financial statements, financial reporting, and the objectives of financial reporting and financial statements, in the components of the financial reporting and types of financial statements. And we had discussion on each financial statement, the components of financial statements, and the purposes and uses of the financial statements. Also, we had discussion on the components of financial reporting. We had there are 5 components. The first one is statement of financial position, a statement of income or profit and loss, cash flow statement, statement of changes in equity, and notes to financial statements. So we'll have a brief discussion on each financial statement. Statement of profit and loss, or we can say statement of comprehensive income or income statement. There are multiple names used. Is the main purpose of this statement is to show the financial performance of an entity in terms of revenue, in terms of gross profit, in terms of operating profit, and in terms of net profit. Basically, the statement of comprehensive income has 2 main components. The first one is revenues, and the second one is expenses. Revenue has 2 portions. The first portion is income from main operations, and then additional incomes or other incomes, from which we subtract. If the company is mainly production or manufacturing, then we'll have cost of goods sold. We'll have to calculate the cost of goods sold, from which we'll find out the gross profit. Then after that, we'll have to list out our operating expenses, from which we have to subtract the operating expenses, and at the end we'll have operating profit. From the operating profit, we'll subtract some non-operating expenses, including including taxes and depreciation and some other expenses. Then at the end we'll have either net profit or net loss. In case of a positive figure, it's a profit. In case of a negative figure, it's a loss. Then we have statement of financial position. It's also called balance sheet, or we can also call that statement of accounting equation, because basically accounting equation is practically available on this statement. Asset equals capital plus liability, or liability plus capital. So this statement has three components: asset portion, then there is liability portion, then there is capital or equity portion. So basically it has two main parts. The first part is assets, the second part is capital and equity. So the total of assets must equal to the total of liability plus equity, owner's equity. So assets, then there are different types of assets, mainly divided into current assets and fixed assets. All the current and fixed assets which exist in different forms and different shapes, and with the tangible or intangible, whether financial or real, they are listed under assets portion and the total is found. Then we have to list down all the liabilities. It could be current liability, it could be long-term liability. Then the total is found. Then we have to list down the owner's equity. The first thing comes under it is capital invested, then additional capital, then retained earnings, and then net profit of the year. The total is found. Then the total of liability is added with the total of capital, which becomes the total liability, and equity, which should be equal to the total of assets. And we have also discussed the uses of the financial statements and how we can use it and what information could be found in what operations could be applied to the financial statements to get the required information. Then we have statement of cash flow, which we'll discuss today. Basically, cash flow statements talks about the cash inflow and cash outflow from the organization in three different areas: investment activities, first operating activities, then investing activities, then financing activities. At the end, net cash flow is found, and that net cash flow is shown on the balance sheet in the cash and cash equivalent portion. Number 4 is changes in equity statement or owner equity statement. This statement shows the movement in owner's equity during a year in an organization. The movement mean increase and decrease of the owner's equity. So it also gives us the information or insight of whether the owner is happy with the business or the owners are not happy with the business, whether the portion of internal financing is increasing or decreasing. Number 5, it notes to the financial statements. These are not like financial statements. They do not have format of the financial statements, but they are supporting reports to the financial statements. They contain important notes about the figures presented on the financial statement. Each financial statement has notes to it, and combinedly we call all those notes to financial statement, which is attached to the set of the financial statements presented to the readers. That's all about the discussion. So let's go and discuss the second thing, which is global and multinational companies, along with the globalization and harmonization. So what is the reason of including this short topic to the lecture? Is basically it relates to our topic because we have to know the differences between global and multinational companies, because we'll discuss the financial reporting side of these businesses, how they report their financial information. So it's important to know what multinational company is and what global national company is, and how they are required to report their financial information and prepare the financial statements. So multinational company are the companies that operate in more than one country. They are usually large multi-million companies that can afford starting large-scale operations in different countries. So the first thing is they operate in many countries. They are multi-million companies. They have large-scale businesses, very big businesses, right? Like Google, like Boeing, like Airbus. So these are multinational companies, right? Like Toyota, like General Motors, and others. The second is global companies. They're also multinational that have found ways to incorporate some same intercompany laws, regulations, and procedures in their offices worldwide. Basically, global company should be a multinational company, but the difference between multinational companies and global company is that multinational company may not have same rules for financial reporting over the world, but global companies, they have same standards, same rules for reporting their financial information throughout the world. So that's the main difference between multinational companies and global companies. Multinational companies, wherever they do businesses, they are abide by the rules and regulations of the company where it's operating, especially from accounting perspective and financial reporting perspective. But global company, they, wherever they operate, their reporting system, their rules, all of them, their regulations, they are standard, and they operate regardless of countries' rules and regulations. They have their own rules and regulations which are accepted worldwide by all the companies. So we can say that every global company is a multinational company, but every multinational company is not required or is not supposed to be a global company, right? Next, we have globalization, harmonization. Globalization of incorporations worldwide began in the era of economic boom. For example, mostly transport and traveling become much easier with ships and airlines in 1970s. Companies moved from country to country to gain customer in large scale. These companies operate in different economic and legislative climates, felt pressure by the governments and shareholders. Financials were supposed to be reported separately for each region and country to meet legislative requirements. So before globalization, these multinational global companies, they were supposed to report separately and meet the legislative requirements of the country. But with the idea of globalization, harmonization has come into existence, and especially international accounting standards, which are now known as International Financial Reporting Standards, has brought a great harmony to these differences in standards and reporting the financial information. So these standards has brought all the companies in all the countries to a single platform where all the countries and internationally all the countries, they prepare their financial reporting accounting rules according to International Financial Reporting Standards or GAAP and are accepted worldwide. And even there has been an agreement between IFRS and GAAP organizations to bring these standards together, so there is a uniformity in financial reporting standards worldwide. So it may happen in the near future or maybe in the far future where we will have a single financial reporting standard worldwide. Now we get to the main lecture, which is basically lecture 3 of the chapter 2, but lecture 5 of the subject or the online video lecture series. the cash flow statement. The balance sheet indicates the amount of cash owned by the business at a particular date, which is derived by preparing cash flow statement. You guys know that the first thing which appears under the assets is cash. So do you know where this number comes from? This number should come from the statement of cash flow. Means that we have to first prepare the statement of cash flow, and whatever is the end result of or net cash flow shown by the statement of cash flow, that should be reflected under the cash portion of the balance sheet. So there are links between the financial statements. Before preparing one financial statement, we are required to prepare another financial statement as a prerequisite. For example, before preparing the balance sheet, we should have first the profit and loss statement, because we have to derive net income from that. Before preparing the financial balance sheet, we have to prepare the cash flow statement. Before preparing the balance sheet, we have to prepare the changes in equity statement, because the information shown by these three statements appears on the final statement, which is called balance sheet. And balance sheet has permanent accounts. There are three permanent accounts: assets, liabilities, and owner's equity. And the others are the temporary accounts. For example, we have revenues and expenses. And cash is also asset. So regarding cash, we should have a separate financial statement which only talks about the movement of cash coming into the organization and going out of the organization, right? So that's why it's important to know how cash flow statement is prepared, because all the decisions taken within the organization, they are based on the cash, right? When cash is there, we can take different decisions, and based on the cash availability, we change our financial decisions. A separate financial statement called cash flow statement, which summarizes all the cash flow activities, inflows and outflows during a specific accounting period. So cash flow statement has three main parts. Number one is operating activities. Means under this part we report all the cash flows, which means cash inflow and cash outflow from operating activities, and operating activities are main business operations. Next we have investing activities. We report all the cash inflows and outflows under investing activities, and investing activities are investment and divestment in assets. Means when we have invested in a business, we have purchased basically assets, or we have brought into existence the assets, or we have sold out the assets. So these activities comes under investing activities, and there is always inflow and outflow. Third part is financing activities. Financing activities is basically investment in business itself. Means acquisition of money, acquisition of funds. It could be from internal source or it could be from external source. You have taken loan or you have paid out a loan. Owner has invested or owner has divested, has left and taken their share capital. So under these activities, we report all the inflow and outflow coming from the financing activities. Okay, let's discuss some of the operating activities. Under operating activities, all the cash inflows are from sales of goods. When we sell goods or services, so we have inflow of cash. So all the activity related to sales of goods and services and the money coming in from those activities are recorded under operating cash inflows. Next we have operating cash outflows. Under this, all the payments to suppliers, to vendors, to employees, payment of interest and taxes and other operating expenses, payments to other operating expenses come under cash outflow activities. So all the operating activities transactions generally involve producing, delivering goods and provision of services. So all the transactions related to producing and delivering goods and services, they are under operating activities, and then we have to see whether money has come in or gone out of the organization, and then we have to categorize accordingly. Next we have investing activities. Investing cash inflows are sale of property, plant and equipment, sale of stock or bond, repayment of loan, receipt of interest and dividends. When we have given a loan, and when we receive that loan back, that is our inflow. We received interest and dividend from other, that is our inflow. We sell out our stock and bond, that's cash inflow. We sell out a property, we sell out a land, we sell out an equipment, a machinery, that is all cash inflow from investing activities. On the contrary, when we purchase a property, a plant, an equipment, a machinery, we pay for that, so that is cash outflow. When we purchase stock and bond, that is cash outflow. When we purchase infrastructure or we invest in other businesses, that is cash outflow. Usually, investing activities involve buying and selling non-current assets and securities, giving out loans and collection on them or collecting them. So all of them, they comes under investing activities. Next we have financing activities. Financing activities, what are they? When we issue stock or capital, stock of capital, that is basically inflow. When we issue stock, when we issue bonds, so against that we receive money. That money is not ours. That is basically the money owed by the business to the shareholders or to the creditors. So basically that money is inflow under financing activity. When we borrow from bank or we get a loan from the bank, all of them comes under financing activities. Okay, what is the outflow? Outflow is dividends payment to the owners or interest payment to the bondholders, or when you buy back the shares. The shares are bought back by the company, so the money is given, that comes outflow. Similarly, when bondholders bring our bond back and receives their capital, that also comes under cash outflow. And similarly, repayment of borrowings and loans also comes under financing cash outflows. Usually financing activities involves obtaining resources from owners and providing return, obtaining borrowings from creditors and repaying principal amount or cost of borrowing or paying interest. All these things come under financing activities. Now that's all about the cash flow statement, right? Now there is an example of the cash flow statement. I'll show you how it's prepared and why each activity is reported under a certain part. There is a company by the name of Universal Pharmaceutical Industry, and the cash flow statement is for the period ended December 31st, 2011. Remember that cash flow statement shows the cash flow of an organization for an accounting period or for a specific period, and that period is usually mentioned at the top, at the heading of the statement. There is only one statement which shows the information for that exact date, and that is the balance sheet. Other financial statements, they gives us information for an accounting period, and that could be of quarter, that could be semi-annual, that could be annual. So that has to be kept in mind. Now let's talk about this cash flows from operating activities. So under operating activities, there are two activities. One is cash received from revenues. So we all know that this is operating activity because the money is received from the main operations, main business. All the revenues are reported under operating inflow. Then is cash paid for expenses. All the expenses paid is. So here you can see that outflow is always shown in the brackets or as a negative figure, and net cash flow is inflow plus outflow. So the net effect is 6,000. 8,000 minus 2,000 becomes 6,000. So $6,000 is the net cash flow from operating activities. Means that in operating activities we had more inflow than outflow. Next we have cash flows from investing activities. Purchase of land and building, 50,000. When you purchase land and building, so we know that we have to pay the money. When the money is paid, it's outflow. So outflows are always shown as a negative figure. You can see it's in brackets. Bracket shows negative figure. Payments from for purchase of tools. Again, tools and equipments, they're assets, and when we purchase we pay money, so that's also negative figure, cash outflow. Usually cash outflows are written first and inflows are written later, but here they have written the outflow first and inflow second, but it should be first inflow then outflow. Net cash from operating activity is 46,000, because you see 50,000 minus 50,000 plus minus 6,000 becomes 56,000. When we add that to 10,000, so minus 50,000 plus 10,000 becomes 46,000, and that is a negative figure, which means that investing cash flows are more than the outflows are more than the inflows. It means that the business has grown, we have more invested in the business, right? Next we have cash flows from financing activities. Investment by owner, that is an inflow. 80,000 investment is made by the owner, additional investment. Movement in cash flow position during the year, that this figure comes from the changes in equity statement. In cash beginning balance, that is given at the beginning, we can take this figure from the balance sheet or maybe from the cash flow statement of the previous year. So that is 20,000, and cash ending, all of them has been added, and you see it's cash ending is 60,000. And how it is made? We have to sum or add 6,000 plus minus 46,000 plus 80,000 plus 40,000 plus 20,000. When we add all of them, the result is 60,000. So ending cash is, or cash ending balance or ending balance, cash balance is 60,000, which is the opening balance for the next year for 2012. So that is how a cash flow statement is prepared. Now we'll work on one of the class activities. I'll prepare for you a cash flow statement, then I'll give you a problem, a practice. You can practice at home, and if you have any questions in preparation of the cash flow statement, get back to me, inshallah. I'm gonna help you. So let's talk about this example. There is a company by the name of Foster Company. The month of January 2001, they have the following transactions, and we are required to prepare a cash flow statement. The revenues are 10,000. Expenses were made 6,200. Equipment was purchased for 2,500. Bank loans were paid off for 2,000. The owner, Mr. Foster, Doc Foster, has invested 5,000, and the opening balance is 5,600. So that's all. Now let's prepare a cash flow statement. So here's a cash flow statement. Alright, let's start. First, I'll write the heading. I'll say Foster Company. Then the statement of cash cash flow. And then I'll say for the period ended January 31st 2001. So let's do formatting. I'll do formatting for it. Okay, I'll merge the cells. Let's merge. Also copy the format and do merge for this as well. Now the merge has been done. Now let's write first the opening balance. The opening cash balance, and I'll write that here, which is $5,600, right? Let me see, it is 5,600. This is the, all right. Now let's do the first portion. The first portion is operating activities. So I'll do formatting for this. All right, I'll also do formatting for this. Okay, so the first operating activity, let's see, what is this? Revenue and expenses, inflow and outflow. So revenue received, or we can say revenue earned. Okay, revenue received. What is revenue received? Revenue received is how much? $10,000. $10,000, right? And then we have expenses made. How much expenses is made? And we have to put as a negative figure because it's outflow. 6,200. 6,200. All right, so it's dollar. That's all. Now net cash from operating activities. Net cash flow. Net cash flow from operating activities. Activities. All right. So we'll do that here. Okay, I'll let's put them in outer column. Okay, let's do formatting for this as well. That's how formatting is done in Excel. Okay, so I'll add this one with this one, and we'll have the effect 3008. So that's a positive figure, means that our inflow from operating activity is more than the outflow of the cash, right? Next we have is investing activities. Okay, let's do for investing activity, let's do formatting for it. All right. Okay, now and let's see what investing activities do we have. There is a purchase of equipment only, that's outflow and nothing else. So let's go purchase of equipment. purchase of equipment, which is how much? $2,500. It's outflow, so we have to put a negative figure, $2,500. That's a dollar sign. And we don't have any inflow activity, so we'll have to put a net. Let's write inflows. Inflows are 0, right? We have no inflow from investing activities, so we have to put that as a 0. Now let's write net cash flow from investing activities, and let's do formatting for this as well. All right, that's all here. Okay, so let's find out the net effect. That is a negative figure, means we have made more investment this year or this month, means our business is doing good, therefore we are making investment. Okay, all right, okay, at the end we have financing activities. Okay, let's do formatting for this. Okay, now let's see what financing activities do we have there. The first financing activity is that there is a bank loan. Bank loan is paid out, so that is outflow. And then there is investment by the owner, so business has done financing from the owner, so 5,000. There is inflow 5,000. So first we'll put the inflow, then we'll put the outflow. Okay, so I'll write investment by the owner. How much investment is made? It's 5,000. Okay, so that's inflow, so we'll have to put a positive figure, 5,000, and it's a dollar sign. Next we have outflow activity, that is loan paid off. Loan paid off. How much loan is paid off? 2,000. Okay, let's do formatting. Okay, that is outflow, so we'll have to put a negative figure to show that this is the outflow, 2,000, dollar sign. Now let's find out the net effect of inflows and outflows. Net cash flow from financing activities. Okay, format. Okay, what is the net cash flow? Let's do it. Inflow plus outflow, the net effect 3,000. It means that the owners are happy from the business, that's why they are making additional investment, and financing activities are a positive figure, right? Money is coming in. So let's find out the closing balance, closing cash balance. Okay, closing cash balance, how it's done? We have to sum up all of the results from top to down, from here to here. We see that there is 9,000 this 9,900 is the cash balance as of January 31st, and this is going to be reported in the balance sheet under the cash portion, right? Okay. Let's do formatting a bit here. These are the results, and we have the end result as a closing balance. We can format as we want, and we can also put the borders like this, and then put a bold border. That's our cash flow statement for Foster Company for the period ended January 31st, 2001. Right. So this is how cash flow statement is prepared. Now you guys are required to work on problem number 1 here. There are 8 transactions. Before going and preparing the cash flow statement, please read each transaction, read it carefully, and decide whether this is operating activity, whether this is financing activity, whether this is investing activity. If, for example, if this transaction is operating activity, then you have to find out whether this is inflow or whether this is outflow. If this is inflow, positive figure. If it's outflow, you have to put a negative figure. Right? So please prepare a cash flow statement for this problem, and then get back to me. And you are required to share with me your cash flow statements so I can check in. If you have any questions, please get back to me. Right? So that's all for today. Thank you so much for being with me, and inshallah I'm looking forward to hearing back from you. Come back to me with questions, with recommendations and all that. I'll upload this class activity to the LMS so you can download, and if you want to use my format, you can use that as well, or you can prepare your own format as well. Right? We can do some other formatting. We can make it bold, and we can make it underline. Right? This is how we do, and this is all. It's all done. Okay, bold, 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 bold plus. All right, and we can put a one line down there to show that this is the total, subtotal. Double underline shows the grand total, and one line shows the subtotal. That's all our cash flow statement. Thank you so much, and bye for now.